Hi guys, Gail Sylvester here. When you took out your current mortgage, were you told that don't worry, if you want to move, we can just port this mortgage with you? No problem. And then they didn't really get into what that actually meant. Well, here's what you need to know if you want to port your mortgage. And the reason I'm talking about this today as well is that interest rates were lower than where they are today. So if you've got a low interest rate on your mortgage and you're like, I don't want to give this up and now take on a higher current rate, if we're on a fixed rate, then we definitely want to talk to you about porting and what that meant and what that means. So you can take your current balance and current interest rate and convert that, port it to a new property. And what you do is you transfer the balance and the interest rate, and then you increase it or decrease it as needed based on the needs, based on your sale, and based on your purchase. But what you don't know is that, or what you should know, is that when you are porting, because you're changing the contract and you're changing the property that's attached as collateral to this mortgage, you still have to requalify based on today's rates and today's guidelines. So it's not a standard that you just take it from one property to another because you are changing the application. So what you have to do is you have to requalify based on today. So what you can do though, if we do qualify, is that so let's say it's a 5 year term and you're 3 years in. So now we've got 2 years remaining, right? So at 2 years remaining, say your interest rate is at like 2.39 and such. What you can do is you can take it and blend the current interest rate with your existing 239 and take a new 5 year term. We call that a blend and extend for a new contract. So what you're doing is you're taking the bulk of your mortgage, potentially based on balance, at the lower interest rate, and then the top up is at today's interest rate, and then you blend those rates. You are still paying a penalty in there. That penalty is calculated in the interest rate. You're just not out of pocket because most people don't think they're paying a penalty to do a port, but you are. You're just not paying it in dollars and cents from your pocket. You're actually paying it through the interest rate for the remainder of the contract. One of the other options is you can just do a blend, like a port and a blend to maturity date. So if you've only got 2 years left on your contract, maybe we just actually do a new 2 year term kind of thing. So that way the maturity date is still the same. You're just blending of the interest rates. And then when it comes up for renewal, at that time, we can renegotiate a new contract in a new amortization and a new interest rate because we're going to keep the amortization the same as well. So if you started out at a 30-year amortization and you're 3 years in, chances are you have 27 years remaining. And that 27 years is what we're going to use to requalify you as well. So there's a bunch of different options. If it makes sense and we can qualify you, then that's what we do. And if it doesn't make sense and it doesn't qualify you, then we're going to renegotiate. Maybe we'll get rid of that lower interest rate and we'll talk about new options. Maybe it's still a short term based on if you're comfortable with the fixed, or maybe we talk to you about the variable rate and we educate you a little bit more as to what you can expect. So if you're looking to port because you want to keep interest rate low, let's talk. Let's work out the different scenarios and let's see what's going to be best for you. Okay, we'll talk to you soon.